Internal range liquidity refers to the pockets of liquidity that exist within a price leg. So when we combine internal range liquidity with things like higher time frame bias, candle liquidations, candle range trading and theory, we can take much higher probability trades. So what I want to do today is just talk a bit about what internal range liquidity is, what constitutes internal range liquidity, and then show you on the charts a bullish and bearish example and how you can use this information to take advantage. And there'll be a bit of detail on how you combine timeframes and internal range liquidity across timeframes to take even higher probability trades. So let's get into it. We're just going to start here with some theory. I'm going to spend ages, but I think it's important to define what is internal range liquidity specifically. So internal range liquidity refers to pockets of liquidity that exist within a price leg. So this isn't the best drawing. I'm going to bring this to life in a much more detail, but we see that this is a bearish to bullish shift. And within this shift, we create a price leg whereby the swing point here and the swing point here has a range of liquidity. And we're calling this internal range liquidity. And there are different zones within this internal range liquidity that we can place trades from. You'll notice here there's this red line. This is the order block. So one of the main points of internal range liquidity is often the order block. And what you see is price stings into the order block and then trades away. So most traders only look at specific areas of liquidity like the order block, but inside every price leg there is always nuance, and we need to account for that because there are other points of internal range liquidity and there's other contexts that will give us more idea as to what zones in that internal range liquidity we should trade from. Why does it matter? Better entries, higher risk to reward, because you can actually reduce your stop loss and get in lower in a price leg. That means higher risk to reward and ultimately less missed trades, because if you are someone that only focuses on the order block, sometimes price won't retrace in that way. It will just hit something else and go. So we need to be able to identify when it makes sense to take trades from those areas. Why internal range liquidity works? So from an institutional perspective, IRL was created in the process of large actors accumulating orders in the market. So in placing orders for hundreds of thousands of units, institutions don't do this in one specific order. Otherwise, price would just skyrocket in that direction. Instead, they build their positions over time. Then price will start to move away from those areas, creating that price leg. And then it will retrace into the structure, the internal range liquidity, where more orders can be accumulated before that move extends. Psychology. So at every level, on every time frame, market makers, institutions are manufacturing liquidity. So in the same way that institutions want to build large positions, in order to do that, they need to entice retail traders, other smaller actors into the market in the opposing direction so that they can buy or sell against them in order to build bigger positions. So in every, whether you're looking at the 1 minute, 5 minute, 1 hour, whatever it is, fake moves are constantly happening to build liquidity, to force traders into thinking price is moving in the opposing direction that can be bought or sold against. So psychology is very important in how these pockets of internal range liquidity are built. Multi-time frame analysis or multi-time frame structure. Every higher time frame candle contains lower time frame internal structure. So if you're looking at the weekly candle, that contains daily time frame internal range liquidity and even down to sort of 12-hour and 4-hour candles. So we can start to piece together time frames and the different liquidity zones on those time frames to make higher probability trades. So how to identify IRL, I'm going to start calling it. You've got breaker blocks, fair value gaps, order blocks, swing points, premium and discount zones. I don't know why, but I've mentioned swing points 2 times. So these are the predominant areas of internal range liquidity that we are going to focus on. And we're going to look at checklists as well. So in order to start mapping IRL in the right way, we need to first mark price legs. So we need to understand how to look for a price leg, what constitutes a price leg, and how to mark the different pockets of liquidity within that price leg. We need to understand the context of that price leg in relation to our higher time frame. We need to always, when we're trading, wait for mitigation of internal range liquidity in order to place a trade. So we're not just buying breakouts blindly, we're waiting to understand where it makes sense for price to retrace to in order to take a continuating move, and effectively manage stop loss placement. This is vital. So having a good read on IRL means that you can effectively create a stop loss that makes sense. Might not always hold, but at least you give yourself a much better chance and something that makes logical sense before you place a trade. So now let's take a look at how to trade internal range liquidity. So we're going to look at a bullish price action, bullish example on Euro USD, and then a bearish example on USD CHF. And before I do that, I just want to cover in a bit more detail how price legs are formed, why they're formed, and what internal range liquidity is created in the formation of those price legs. And this is, of course, just a visual example. So we have bullish candle that then gets sold through, creating the formation of an order block. What price is expected to do, purely from a liquidity perspective, is come into this order block and then sell off. And that does, to an extent, happen. You get a sting here below the low of the price leg that is created. But then what you get is a shift. So bullish aggression coming into the market. And essentially that's where price is currently sitting. So what is happening right here? First and foremost, we have bearish price leg between this swing point, the high here of the bullish candle, and the low that is created in the market. So we have a price leg down, and then we have essentially a shift whereby a new price leg is created. If we just look at price purely in these two instances, and let's mark this in red to signify that this is bearish action turning into bullish action. So first and foremost, what do we get? We get a structure shift. So I can mark that there. So a true market structure shift. And then what we can do is better define the points of liquidity in these legs. So in creating that initial sell-off, I'm just going to remove this for a second, we have an order block. So this is where institutions are accumulating orders, buy pressure, and then distribution, selling off. So if you think about what is then the next logical thing to happen, price will trade back into this area where accumulated orders have been accumulated to further fill larger positions to then continue in the same direction. What ends up happening is we swing below the low and then trade straight through. And in doing so, we create a new price leg, as I just mentioned. This time, it's a bullish price leg. So if we just mark this as order block right here, and then we have a new bullish order block, because this is the last sell candle before buy pressure. What we also see created here is between the imbalance of this candle and this candle, this third candle, we get candle 1, a surge of bullish price action, and then we get a close of candle 3. And between the wicks of those two candles, you see there is an imbalance. This is known as a fair value gap. So this is a point of internal range liquidity whereby price, demand stepped into the market. There was a surge of orders. Anyone that wanted to get involved here was left behind because demand outstripped supply. New imbalance created, and then what essentially can happen next is that potentially price can just sting into that imbalance. That demand that is stalling in the market or building then takes price higher. So that's a potential scenario. What we also see is a breaker block formed. So we can now drag this across. And what a breaker block is an old area of supply or demand in the market that then becomes support in the opposing direction once it's traded through. So you can call this a flip zone or a breaker block. It's essentially an old area in the chart that showed accumulating orders that were essentially disrespected, a flip from supply to demand. So we can now call this a breaker block. And I'll mark this, it could be green, or we could just mark it as sort of a neutral color right here. And again, this could be used as something to take a trade from. We could maybe place a stop below the breaker block itself, and again, use that as our fuel to go higher, rather than waiting for a retracement into that fair value gap. So there's two things to note here. In order for all of these zones to be created, you need to wait for candle closures so that you have verified zones. Secondly, the more zones that you can stack, the greater confluence there is that price will continue in that direction. So what we have here, if we're looking for bullish trades, is the likelihood now that we see this becomes much less, because you have imbalance in the fair value gap through aggressive price action. You have old supply flipped to demand, and you have a block right here, the order block, which saw the accumulation of orders. So that is an unlikely scenario right now, unless this is a more advanced concept that becomes a vulnerable low through the creation of a higher time frame candle. But for now, let's just use the logic that we have support here that is more likely to drive price higher. So we're much more likely to find either this area or maybe the order block and go higher. So that is the premise. That's what we're looking for. The final points to mention are swing points. So we also have the swing low and the swing high. So in this instance right now, this could act as resistance, this swing point, and this could also act as support, because what you could see is that price does this, whereby it wants to then liquidate the price leg, but actually it does so without closing below. It doesn't create a new price leg lower. What ends up happening, let's just imagine that this is multiple candles rather than one candle. You get this type of thing happen where a wick wicks below before a subsequent move higher. And the reason for that might be that a new candle has created a vulnerable low, or actually it's purely manipulation, where you're starting to see the accumulation of orders in the market. Price liquidates those orders, collects more orders before the move actually happens. So again, it's something to take note of because it does happen. So let's just take that away and actually look at two examples on the chart. Okay, so let's look at firstly a bullish example using Euro USD, and then a bearish example using USD CHF. We're going to look at swing positions, so executing on the 12-hour time frame using higher time frame candles. I'll go on to explain that. So if we just zoom into price quickly at this low to see what's going on, and we map the path of price. So we have this swing leg or price leg lower, retracement in, we come off the order block, we try to go lower, and then we get a shift. So going back to what we were just discussing, we can see first and foremost that there's been a shift in the market right here. So as soon as we get that, we can start to mark our price legs. So right here, you've got the bullish order block. So this is the last sell to buy candle. And it's coming, if you see here, from another bullish order block. So as soon as we get that extension there, we can see that while we saw this sort of like higher time frame shift, if we actually look more deeply, we get a retracement into the order block. Price tries to push lower. In doing so, we get demand stepping into the market. So the last sell to buy, new price leg created. So that's almost your confirmation, and you get further confirmation with the actual structure shift right there. So this is what we're looking at in terms of our price leg. So you've got order block and then subsequent bullish order block. What we also have in here is the formation of a fair value gap. Again, I'm just going to keep this green so you can see that it is bullish. And you can see right there, it's an imbalance in price between the two wicks of those candles. Interestingly, in this example, there's a gap up very aggressively right there, shows that aggression in the market rather than it being between candle 1 and candle 3. 99% of the time, it's going to be between candle 1 and candle 3. What we also have is a breaker block that sits here. Let me just mark that in a neutral color, and I'll just add breaker block. So this was the old order block that eventually got traded through and disrespected. So you've got there then the various points that we discussed of liquidity. You've got the swing low for the first leg, you've got the swing low for the second leg, and then once we start to see this retracement, we've got the swing high. So that can act as a draw or further target for us in the market. And of course you have this whole area being the entire area of sort of support that you'll see for your trade. That's probably going to be IRL or an order block on a higher time frame. But let's just stick with this this area here. So in terms of placing trades, there's the best thing to do is start thinking about how you can stack zones together. So here you've got a breaker block with an overlapping fair value gap. So that could be your first thought of entering into this long position. You also have the order block, the extreme here. So if you are to take a trade from the order block, covering the low, so the swing point in the price leg, then just trading back to the high, you've got a 2.5R trade, just using one time frame. If you are to take the entry from the fair value gap in this instance, then you would need price to run a lot further to actually gain the RR that you're targeting from your trade. But that's the premise of using internal range liquidity. It's waiting for that structure shift, mapping the different points so that you have that context to place trades from. Now, where this becomes really useful is understanding it in context of higher time frames. So as always, I like to trade candle ranges. So I'm just going to overlay the 2-week time frame onto our charts so that we can see what's actually going on here. And you can see we have in this entire 2 weeks of price action a bearish candle that prints lower. We then get this consolidation and a shift, and at that point what's happening is that we're liquidating here, I'll mark that in a slightly different color, the low of this candle. So you can see here's the high of the candle, the low of the candle, and the body of the candle. So this is the low. The second candle manipulates below, and then we see a structure shift. So logically, the next target for price could be the high of the candle that was manipulated, this accumulation candle. So this can just give you a very sort of low stress way to swing trade this idea, whereby you're looking to get involved either from the fair value gap, covering the swing point for a 3.8R trade, or you want to wait and see if you get tagged in from the order block, also swinging, covering the swing low for a massive 7.5R trade in this instance. The only risk in doing that is that you may find that your order block doesn't get tagged. So that's something to consider. But this is how you could use refinements from internal range liquidity to play out this swing trade idea. Now we're going to look at a bearish example. Actually, sorry, I've got this prepared. So on USD CHF. And again, I'm just going to show you how you can start to piece this stuff together to take profitable trades in the market. So we have price leg lower, price leg higher. So then we come off of no internal range liquidity in this instance. So we found some support in this order block right here, traded higher. You see the formation of this order block. We trade higher, so we have this price leg. Then you get this shift, close below. We trade back into this order block here, trade lower, create a new order block, and then sell off. So that's the path of price right there, and you can see the shift from bearish to bullish occurs right here. At this point, you get this sell candle, buy price action, shift into this price leg here. And if we just take a look at what's going on in this price leg, we have the shift that I talked about. We have, first and foremost, a breaker block right here. And I mark that as a breaker block because that was the demand which got traded through. Then we have a new order block here. I mark that in red so that it's clear. Order block. And then we do have actually a very, very small bearish fair value gap as well. So an imbalance in price, and I need to really zoom in to be able to create this. But you can see that there is an imbalance between candle 1 and candle 2. So if we just bring that back, so we have our order block right here. I can mark that with 12-hour order block. And we have this corresponding breaker block. We also have this slight imbalance of the fair value gap internally. It's sitting clustered within the order block. So again, logically, if you did want to take this trade, you could take it from the order block. You can either cover the liquidation, so this candle liquidated the buy pressure before selling off, or you can just take the entirety of that area. The actual order block itself is just here. Let's just leave that as it is. You could also actually, in this example, just take the breaker block. So as soon as you get that shift and cover the high of the breaker block, that also gets respected. So the order block gets tagged, but you never actually trade through. If I take off this initial entry, never actually trade back through the high of the breaker block right there. Price just respects, then creates another order block, another price leg. Let me take off the order just so you can see this. So you get the retracement into the order block, new price leg, no fair value gap in this leg, but new order block created. So these zones are starting to stack right here. We then get a retracement and then a sell-off. So you've got multiple entry points. You can enter from the order block right here, or you could enter from the breaker block right here, covering the high. It's getting a little bit messy, so let me just move this over. There's the breaker block position right there. And then once you get the creation of the new price leg here, you could take an entry off the newly formed order block. So it's just using internal range liquidity as it's created, and then we target the low. And I'll explain why this again is a low that you would want to target. So there you have 3 trades, 5.3R, 5.6R, 4.7R. And if we overlay here our 2-week candle, actually in this instance it's a 1-week candle that I've got here. Let me just take a quick look at what happened from a 2-week perspective. So okay, we're looking at the 1 week in this instance. So when I'm taking swing trades, I look at the monthly, the 2 week, the weekly. What are we doing right here? We're liquidating again the previous candle's high. So as soon as we do that, I'll mark that in black. As soon as that candle closes right here, you can see we test this order block, which activates that 3rd trade. So here you're getting in slightly early, but that's okay because you've seen your shift. Here you have confirmation that we have a liquidation, and it exposes this target, the low of the accumulation candle. So this becomes a weekly CRT. Price action in, attracting breakout traders, shift into internal range liquidity, shift into internal range liquidity, sell off to the low. So we've looked at a bullish example in Euro USD, a bearish example using USD CHF, and this is how you start to marry higher time frame bias with lower time frame execution, executing from internal range liquidity. And just to sort of finish off, a couple of must-haves here. So always trade in line with higher time frame context. Whether it's order flow or market structure shifts, this shift in the market from buy to sell, this gives you confirmation. It doesn't always get respected, but it gives you a lot more confirmation than not having it before placing a trade. So that's something that I'd always look for. You want to have clear higher time frame targets, and these are created in the formation of higher time frame candles. There's other videos that I cover this concept in detail, so don't worry. You want to have confirmation of the IRL zone, so wait for candles to close before you take entries and confirm those IRL zones. And you want to trade from retracements into those price legs from those zones rather than just buying a breakout as it occurs. Common mistakes are essentially doing the exact opposite, so ignoring higher time frame context, trading every single price leg that's created, taking every IRL zone that is created, not understanding IRL and how it's created, so you're placing stop losses that don't make sense, and forgetting that IRL in isolation is not a trading strategy. You don't want to be placing trades simply on the formation of IRL. You want to do it in context alongside higher time frame context or higher time frame bias, and that's through candle range trading strategy. So this has been a breakdown of how to think about IRL, what it is, why it's important, the mechanics of how it's created. We've looked at two examples, a bullish example and a bearish example, both using weekly and 2 weekly context to actually place and refine our trades. And that's led to substantial swing opportunities in the market. And this is the sort of thing that I'm doing all of the time, every day, analyzing the market across 32 different Forex pairs to take advantage of these moves in the market. Please follow along, subscribe. I'm going to have a lot more content both on trading strategy, but also the trades I'm taking. So yeah, I look forward to seeing you on the next one.